Hey, what's up guys? This is Ian, and today I'm gonna talk to you about two relatively cheap stocks that are a must-have on portfolio before this 2020 year ends. As we all know, until now, this has been a very volatile and unstable year. One day, everything seems dark and mournful, and the next day something happens and everyone recovers faith in capitalism and everything seems to be peaches and cream. But as investors, our main virtue have to be our emotional control and objectivity, so we can't be affected by the rush of news and becoming excessively optimistic or excessively pessimistic. As I will be constantly telling you, investing is a perseverance race, very boring and not exciting at all if you do it right. And for these stocks I'm about to analyze, it's better to operate with a plan of at least 3 years future. The first stock I want to share with you is Agilent. It is listed in the New York Stock Exchange with the ticker A. Right now, Agilent's price is around $85–86. This is a very high quality business, crisis resistant, that doesn't get affected by the current pandemic, with low debt, and a very good perspective in the long term since the expense on investigation and development is rapidly growing globally. In fact, during the last 20 years, investing on these types of company have ended up being brilliant operations. The secret of this business is on their recurrent sales. Initially, the company sells their product in a very low profit margin to hook the customer. Then, this margin multiplies for the maintenance, calibration, and supplies for the product. This business model is the same model that uses, for example, Gillette, where they sell you the razor at a very low profit margin to then recover by far with the sales of the blades. Currently, Agilent is listed at a pair of 25. If you don't know what the pair is, or you don't really understand what it is, I will make my next video about it. How can you calculate it and why it is so important when we are analyzing a stock. But if you happen to know what it is, you may be wondering why to invest on Agilent when it is trading at pair 25. The main reason is that Bill Ackman just took over a huge part of the company, and his plans for it is to influence or even change the board to seek a growth in the company revenues and consequently a stock price raise. This is what we call corporate activism. Comparing Agilent to its closest peer, which is Waters, it's evident that there's plenty of room for margin adjustment by reducing costs. Just like Bill Ackman himself have said, if he successfully achieves this plan, Agilent's stock price may double in a 2-year term. However, if he happens to fail at this, there's a very low possibility for this stock price to crash, and that is due to the high quality of this business nature. On Agilent, I remember opening my first operation on October 2010, around $24 per share, and closing the half of it on April 2018 at $63. So, even when I had a pretty bad timing, it went pretty good for me, with around 130% profit. I still own the other half of the shares and just opened a new position for it around $84 last week. So, for our concern, we may have a target price of $160 per share between 2022 and 2023, as long as any important fundamental success, either good or bad, doesn't happen. And that, my friend, is around a 90% profit in our investment. The next stock is PNC Financial. It also trades in the New York Stock Exchange with the ticker PNC, at this moment at around $105. PNC is an American bank holding company and financial services corporation based in Pittsburgh, and they offer the typical services of a bank: accounts, credit cards, transfers, mortgages. Their shares value have multiplied for almost 40 times since they went public in 1972, and it is already a consolidated bank. That's why they return almost all their benefits to their shareholders, a high 5% dividend yield. But this also implies that their future growth will be stable but slow. They also have a low late payment rate below 1%, which they have been reducing the last years. Now, how can we correctly value this bank? A good and reasonable way to value a bank stock is to focus on the return over the tangible common equity of the bank. If it is around 15%, in this case it's slightly above 14%, it should be trading around 3 times the tangible book value per common share, which for PNC, according to their last year publications, is around $83. This brings us a target price between $180 and $220, a very interesting potential of 80% growth in the next 3 years. Remember, my friends, that all of this info is public and can be investigated by yourself very easy, even by Googling the company name you are interested along with the words investor relations, which should take you to the company investor's website where you can find annual reports, press notes, presentations, and all the info I'm showing you here. So that's it for today, guys. I hope you enjoyed this video and helped you to understand some factors to take into account when picking up a stock to buy. Remember to share this video, hit the like button if you enjoy it, and see you in a couple of days.